Good morning, ladies and gentlemen. First of all, I would like to apologize for Tuesday. I couldn't meet you. It was because of the load shedding. That's why we had to organize and meet again today online. And sorry for disturbing your long weekend, but we just have to push so that when the assessments come, you will be a little bit safer. Right. Today we want to look at the last time we did a statement of profit or loss of a close corporation. Now today we want to move on and do the statement of changes in equity of a close corporation. Not a statement of changes in equity, it's called a statement of changes in net investments. And if time permits, maybe we can also talk about the statement of financial position. But if it doesn't permit, we'll do the statement of financial position on Tuesday. Right. So first of all, I would start with the general format of a statement of changes in net investments. So for a close corporation, it's not called a statement of changes in equity. It's rather called a statement of changes in net investments. Right. You are going to learn why it's called a statement of changes in net investments. Right. I would start with the format. Right. Our statement of changes in net investments includes all items of equity and also loans to members. Right. So you find that we'll have the following items that can be there when it comes to a statement of changes in net investments. It's not always that all of the things that I shall show you will be included, but sometimes they might not be there. Right. We will always have members' contributions. There will always be members' contributions in a CC. Actually, members' contributions is the capital that is provided by the members. It's called members' contribution. So this one will always be there. Then we've got retained earnings. Unlike a sole trader in the partnership who share all the profits to the owners, a CC in the company, they don't distribute all the profits. Some of the profits are kept within the company. So those profits that remain within the company are called retained earnings. Those profits that remain within the company, those are the ones that we call retained earnings. Right. We also have revaluation surplus. Revaluation surplus arises when land and buildings are revalued upwards. I think we know that most of the assets, they depreciate, but we've got one asset that does not usually depreciate, which is land and buildings. Land and buildings, it rather goes up. So if they increase, we record in the revaluation surplus. We've got asset replacement reserve. Asset replacement reserve, these are profits that are set aside for the sake of replacing assets in future. So maybe you know that when you are buying an asset, it needs a huge capital commitment, which might not be raised within a short period of time. So to enable the entity to purchase such assets, the money can be raised in bits and pieces. So whatever has been put aside for the sake of replacing assets, that's what we call asset replacement reserve. Right. We have got mark to market. Mark to market refers to increase in the value of shares. Like a company, when they've got excess funds, they can buy shares in other companies. Now, when they buy shares in other companies, if those shares are not for trading, that increase will be recorded under the mark to market. That increase will be recorded under the mark to market. Right. Then we've got loans from members. So these are the two reasons why we don't call it a statement of changes in equity and loans to members. Because it's no longer equity alone. Loans from members is a liability, and loans to members is an asset. So the fact that it's no longer equity only, there's a liability and an asset. That's the reason why it's no longer called a statement of changes in equity. It's rather called a statement of changes in net investments. Loans from members, these are amounts provided by members, not as contributions, but as loans. That means like a CC can have financial needs. And then to reduce risk, someone with funds, a member with funds can say, no, I have the funds, but I'm not willing to give you as contribution. I'll give you as a loan. Why? Because a loan usually will have a predetermined date when they will get their money back, and they will know exactly the interest that they're going to charge. Unlike members' contributions, whereby whatever you're going to get depends on the success of the entity. If things are bad, you don't receive anything. If the business is making a loss, and if the business does not have cash. But now, if you give as a loan, you are guaranteed your interest. And if you are told that you will be repaid back after 5 years, barring any other problems, you get your money after 5 years. So you can give a loan. Then at the same time, members can also come to the CC in need of money. Maybe you need to pay school fees for your kids, or there's a funeral, but you don't have money. You can go and borrow from your colleagues through your CC. So that's where we have what? Loans to members. Right, then total. So because of the loans to members and loans from members, that's why it's not called a statement of changes in equity. It's no longer equity alone. It also includes asset and the liability. The liability is loans from members. The asset is loan to members. Right. Then we'll have our total. Our total is simply adding up everything that we have there. Right. You start with the balances at the beginning of year. These are the balances that came from last year into this year. Right. Then we'll have your movements during year. These are also called the changes that happened during the year. These are called movements or changes. So you'll be looking at any changes that happened in the above items during the current financial year. Right. So we can have VM additional contributions from members. They can decide to increase their capital. So it will be added on the members' contribution and also added on the capital. Right. Then we can have withdrawal of contributions by members. Maybe you find that the capital is just too much. Let's reduce our capital. You can withdraw the contributions. These ones will be subtracted because money will be going out and also subtracted on the total. Right. Then we've got total comprehensive income. Right. Let me just give a brief description here. Total comprehensive income can be made of 3 things. Right, the profit or loss for the year, is entered under the retained earnings. It will add to the or subtract to the retained earnings. If it's a profit, you add. If it's a loss, you subtract. Profit or loss for the year is entered under the retained earnings. Then we have got a revaluation surplus on land and buildings during the year. Is added to revaluation surplus. So if there were any, because remember it will also be part of the total comprehensive income. Then fair value gain on investments in shares. That are not held for trading. Is not held for trading. Are added during, let me just emphasize that during the current year. It was for the previous years, it will be in the opening balance. Are added mark to market. So those are the ones that make up the mark to market reserve. Then the total comprehensive income, which will be made up of the three above items, will be added to the total. So that means here we'll enter the profit or loss for the year. Then this one will be the revaluation surplus during year. Then this one will be fair value gain on investments during the year. Then this one will be the total. Right. Then we'll have interim profit distribution. A profit distribution, I think I explained in the previous class, that is the share of profits that is given to the members during the year. So when they say interim, that means it was given during the year. During the year, they can just decide that let's give something to our members. So that would be the interim profit distribution. And interim profit distribution comes out of the profits, so it is subtracted from the retained earnings and also from the total. So it's like a dividend or a share of profit given to the owners who are the members. But then we also have a final profit distribution. A final profit distribution is done at the end of the year. It is also subtracted from the retained earnings and also subtracted from the total. All right. Then we can also have transfer asset replacement reserve. As I said earlier on, normally to buy assets, it requires a huge investment, and we might not have that money within a year. So you find that businesses, they can set aside a fund for replacing assets in future, whereby every year part of the profits will not be distributed, they will be set aside for that purpose. So that's a transfer to asset replacement reserve. Right, a transfer to asset replacement reserve are profits that are set aside, so it will come from the retained earnings. So we'll subtract on the retained earnings, and then we'll be add on the asset replacement reserve. So we'll subtract on the retained earnings and add on the asset replacement reserve. So because of the negative and the plus, there will be nothing here. It will not affect your total. It will not affect your total. Right. Then there will also be additional loans from members. The members can give more loans. They will be added to their loans. Right. Then we can also have repayments of the loans from members. We can repay them. Right. A loans from members is the name. Don't be confused. It doesn't mean that they are the ones repaying. It means we are paying the loans from members. So that will deduct or reduce our loans here. I think I forgot to tell you the loans to members, because it's them who are owing. Remember, this represents the investments of the owners in the business. So the loans to members will be shown as a negative. And any increases on the loan to members will be negative, a decrease will be positive. Why? Because these ones, they represent what belongs to the owners, whilst these ones is what they owe. Loans to members, they will be owing the business. So that's why we put it as a minus. It reduces their investments. Right, then they can also be interest capitalized on loans from members. You should be very careful. There are two ways in which interest can be treated. It can be capitalized to the loan or it can be paid by the member. So if they say it is capitalized, that's the only time that we add it to the loan. When they say it's capitalized, that means they are not paying now. They will pay it together with the principal in future. So it is added to the loan at the moment. So whenever they say interest is capitalized, please remember that you have to include it in the statement of changes in equity by adding it to the loan. But if it's not said interest is capitalized, don't add it to the loan. It will not feature in the loan. Right. Then we can also have additional loans to members. We can give them more loans during the current year. Loans to members, remember, when they increase, we put it as a minus. Then we can also have repayments of the loans to members. They can also repay these members. So that means whatever they have, their loans will reduce. And remember, is the opposite on loans. When they interest capitalized on loans to members. The same way, like what I talked about on loans from members, they can say that they are also capitalizing interest on the loans to members. So if they capitalize, that means the interest is being added to their loans. So remember that on the loans to members, we do it the opposite way. An addition will be shown as a negative. A subtraction, a reduction will be shown as a positive. For reasons that I told you, that this one reduces their investment in the business because they will be owing. Right. Then you get your balances at end of year. It's not all those things that I've shown that will be there in your, maybe in your exam or in your assessment. It's some of them will be there, not all of them. So that is the general format of our statement of changes in net investments. I think some of the things will become more clear as I do an example. Do we have any questions? Right, if we don't have any questions, then I'll move on to question 10 on the document that I gave you. So we'll be using question 10. We'll be using question 10. Right, Isaac and Rebecca are the only members of Jacob CC. They have an equal interest in the corporation and distributes profits accordingly. On 28 February 2017, the financial year end of the closed corporation, the bookkeeper presented the following information to the accounting officer, who is also required to prepare the financial statements of Jacob CC. So we've got those, that list of balances. All right, let's go to the required. A, calculate the total comprehensive income of Jacob CC for the year ended 28 February 2017. Right, in number 2, prepare the statement of changes in equity, changes in net investments of Jacob CC as at 28 February 2017. First of all, let's do part A, calculation of the total comprehensive income. We did the profit or loss. So it's just like the profit or loss. But normally, if they say calculate instead of saying prepare, that means there's something else there. Because normally, if they want you to do the profit or loss, they would say prepare the statement of profit or loss. But they said calculate the total comprehensive income. You find that usually when it's like that, you'll be given the profit. That means the profit has already been calculated, but it's before taking any additional information into account. So when we calculate our profits, we have to go on the additional information, check if there were any omissions. By omissions, we mean transactions that were not recorded. Is that right? Then errors that were made. So errors we correct, omissions we record them. So that's what we'll be looking out for. Right, so now let's do the calculation of total comprehensive income. So please, if you don't understand anything, stop me there so that I can be able to explain to you. so that we can be on the same page. Right, question 10. Right, calculation of total comprehensive income of Jacob CC for the year ended 28 February 2017. Right, we'll start with the profit for the year that were already given. Then we'll adjust it for any omissions, errors, and stuff like that. When is our next assessment, ladies and gentlemen?
On Saturday.
This coming Saturday?
Yes.
And what are the, sorry, I didn't check last time. I saw that I did the program that was released earlier this year, but I saw that there were changes there. What are the topics?
Companies and close corporations.
Close corporations is this one?
Yes, and companies.
And what?
And companies.
Companies. Yo. So I saw there's a mistake there. Okay, we'll do the close corporate. We'll see if we finish earlier, then we can do the statement of financial position, then we can see if we can be able to do the companies. But if you are doing FAC 1602, you don't do company. It's only for FAC 1601. I think that's when maybe when you see your assessment, you see that the last questions, they will be different. Or maybe you will not be doing the last questions. Right, so let's proceed. A profit for the year. That is before adjustments. Or maybe what we can do is we can convert, if I don't get a chance during the week, we can convert since it opens on Saturday, we can convert the Saturday class into an online, then we do the companies before you do the assessment, so that when you now look at the assessment, you will have done it. Right, I think that's the best that we can do. Right, our profit before adjustments was 498,900. Right, so my friends, the profit has already been calculated. So we'll be looking for errors and omissions and adjust for them. Right, so we have VM, additional information. Land and buildings were revalued by an independent evaluator to an amount of 900 as at 28 February 2017. Now, if land is revalued, we have to check what was the land before the revaluation. Then you adjust for the difference. Our land here, if you can see, it was 749. So it's now revalued to 900. That's what we call revaluation surplus. So it also goes in the calculation of total comprehensive income. But first, remember, we first have to find the profit for the year. Remember from our previous class. So we just have to calculate it, but then we'll find it, we'll use it at a later stage. So we'd say revaluation surplus on land and buildings. We'll need it. remember that it's included in the calculation of total comprehensive income, but at a later stage. So we take the new value, which is 900,000 minus the previous amount, which is on the list, the original cost, which was 749,000. What do we get? I'm waiting for you guys.
$151,000. 151.
So we're going to account for that. When we account for after finding the profit for the corrected profit for the year. Right. So let's it will hold like that. Then the SARS income tax amount owing on 1 March 2016 was 45,000. The SARS statement indicated a total amount of 180,000 paid to SARS during the year, and the tax expense must still be recorded. So we were owing 45,000 at the beginning of the year, and we paid 180,300. Obviously, that 45,000 is part of the 180,300. But remember, when we record our expense, we are only interested in the income tax expense for this year. We only include expenses and incomes for this year in our statement of profit or loss. Then after paying, we are told that there's a debit on SARS. My friends, you should know that if there's a debit, it means SARS are owing us. That means we overpaid. Remember, a debit represents, for SARS, it represents an asset. So that means when we paid this 180 for this year, we overpaid by 36,800. So that means our income tax expense. But if it was a credit, it could have meant that we are still owing SARS. A liability is a credit. So it could have meant we are still owing SARS. That could have meant that on top of that 180,300, we still haven't paid another amount. So to get our income tax expense in this particular case, which we might need later, not now, our income tax expense would be the amount that we paid according to number 2 additional information, which is 180,300. This is what we paid. But then we take out 45,000 because that was for last year. Then we also take out the one on the list, 36,800, because it means when we paid the 180,300 this year, we overpaid. So that will give, but the SARS, the one on the list, if it was a credit instead of subtracting like what I did, I could have added, because it could have meant that the amount we paid was even less. We are still owing SARS. So you should be very careful there. You have to check. But in most of your questions, I think like the one that we did last time, they will always tell you that the income tax expense was so much. But here they didn't tell us the income tax expense. They simply told us what was paid, what was owing from last year, and what SARS owes us from this year. And again, from last year, if SARS was a debit, instead of a subtracting, would have added. So they are opposites there. So don't be confused there. A debit from last year, you would add, whilst a credit, we subtract like what you did. Whereas a debit for this year, we subtract, and a credit for this year, we add. A debit means SARS is owing us. A credit means we are owing SARS. Right. So that means this will give us our income tax expense. What do we get there?
98,500.
19 is what?
98,500.
Right, 98,500. So that would be the tax. Again, we'll account for it later. I just wanted us to make sure that we've calculated it. Right, then number 3. On 31 January 2017, a check was made out to Mulondo Bozi Computers Limited for 21,000. This payment was for the rent of a server from 1 January 2017 to 31 July 2017. The transaction must still be recorded in the accounting records of the entity. So that's an omission. They said must still be recorded. That means it's not recorded. It was omitted. So we have to include it. It's a rent payment. But we should be very careful. This rent was for January up to July. But our year is ending in February. When we're doing a profit or loss, we're only interested in expenses and incomes that pertain to the financial year for which we're preparing. So the rent that we're interested in is only for January and February, our year end. That is, out of those 7 months, we're only interested in the rent for 2 months. So we'd say the rent of server, rental of server, would say 21,000 multiplied by 2 divided by 7, because the total that was paid was for 7 months. That is from January to July, but we're only interested in the 2 months. What do we get?
$6,000.
So we subtract 6,000. Because we're saying on our expenses, they had not subtracted this 6,000 because they said they had not subtracted it. So you should remember that omitted expenses you are supposed to deduct them. Omitted income, we add. Because we're saying when they calculated that profit, they had not subtracted this amount. But you should be very careful, as you saw, that we are only interested when we're doing the profit and loss, we only want what was for this year. The other part for the 5 months will go to the statement of financial position as prepaid expenses. So the other months, we are not saying we don't record. It will be recorded, but not in the, when we calculate our profit, it will be in the statement of financial position as what we call prepaid expenses. Any questions there? All right. So we'll go to the next one. A insurance expense included an amount of 1.6 relating to the insurance premium for March 2017. This adjustment is still to be made. They've got insurance, which is for March. Remember what I said on number 3. Our year is ending in February, so this insurance was not supposed to be included. So we have to take it out. It was wrong to include this because they said the insurance expense included an amount of 1.6, which related to insurance for March. So we have to take that insurance for March out as it doesn't belong to this reporting period that we're talking about. So that's a prepaid expense. So it's not supposed to be included within our expenses then. So we have our prepaid insurance. We take it out. And when you take out an expense, you should be very careful. If an expense was wrongly included, that means it was subtracted. Remember, expenses are subtracted. So to take out an expense, you add instead of what? Subtracting. So to take out an expense, you add. To take out an expense that was wrongly included, we add it back to reverse the subtraction that has been done. If it is an income that is wrongly included, to take it out, that's when you subtract. So this prepaid insurance was wrongly subtracted as an expense. So to reverse that, we have to add back. Right. So you should be very careful when an expense has been wrongly included, which you have to take out. People will just think that when taking out, I should subtract. No, when you are taking out an expense which had been wrongly included, we have to add to the profit. Why? Because when they included it, they subtracted it when calculating the profit. So to reverse, we have to add. Right. Then the initial loan from Isaac was obtained on 28 February 2016. That was sometime last year, 28 February 2016, the end of last year. That's when the initial loan was taken. An additional amount of 100,000 was obtained from Isaac on 1 January 2017, which is this year. Interest is calculated at 8% per annum and must still be recorded. That means this interest was not calculated and is also capitalized. Right. When we're calculating the profit, the interest is included, whether it's capitalized or not, it's not an issue. The capitalization or not is not an issue. We always include the what? The interest on loan, whether it's capitalized or not. Right. So we're going to say right, but you should be very careful. It's 8% per annum. That means if the loan has been there for a full year. But here, this 100,000 only came on 1 January. Our year is ending in February. Right, the loan from Isaac, if we get here, it was 195,500. And the 100,000 came in January. That means the remainder, which is 95,500, came last year. So what is the implication? The 95,500 will have a full year's interest. But the 100,000 that came in January will only have 2 months interest. The 95,500 which came from last year will have a full year's interest, whereas the 100,000 will only have 2 months interest since it came on 1 January. So they have our interest on loan from Isaac, right? Interest on loan from a member is an expense. Why? Because the business has to pay that interest. So would say 195,500 minus 100,000. This one we're going to multiply by the interest rate, which is 8%, the full interest for the year. Then plus 100,000 times 8% times 2 divided by 12. My 2 divided by 12 is coming from the fact that the 100,000 came in January and our year is ending in February. If you can see here, our year is ending in February 2017, but the 100,000 came in January 2017. So January and February is 2 months. So that means this 100,000 will only earn interest for 2 months, whilst the other 95,500 will earn interest for the full year. Right. What do we get? I'm waiting for you guys. If you have got the scientific calculator, you can calculate through and through straightforward. But if you are using these other calculators, then you have to
$3,973.33.
10,000.
8, not 8,000.
8. Uh-huh.
973.33.
So it's 973 if we round off. That looks too small.
It's
Are you using your
8,000
brackets properly there?
Yes, it's 8,973.33.
Or 8,973. Okay, that makes sense. Right. Then we have on 25 February 2017, the members decided that an amount of 60,000 must be equally distributed to them. Thank you. On 28 February 2017, as a further profit distribution. So they are distributing 60,000. It was further agreed that 50% of this profit distribution will not be paid out in cash, but will remain in the close cooperation as loans from members. 60% of all the loans from members must be repaid on 1 May 2017, while the remaining balances are repayable on 1 March 2019. Now, this is a distribution of profits and loans. They go to the statement of changes in net investments. Right. Then, in order to consolidate a minor debt, Rebecca requested a loan from the close corporation. The loan was advanced to her on 31 December 2016 at an agreed interest rate of 10%. The interest on this loan is capitalized, and the interest for the current financial year must still be accounted for. So we've got an interest on loan to Rebecca. She was given on 31 December 2016. And our year is ending 28 February 2017. So we're only going to charge her interest for 2 months. We can't count December because she was given at the end of December, 31 December. So it will only be interest for January and February at 10% of the loan. The loan is the loan to Rebecca. Yeah, 10% of 7,500. So we'll have our interest on loan to Rebecca. This one will be income to the CC because the CC will receive the interest. So we'd say our percentage, which is 10%, multiplied by our loan, which were given on the list, 7,500. Then we don't forget that this was only for 2 months. What do we get? What do we get, my friends?
$14,508.
It's what?
14,508.
Is it 40? This one, I think, be very careful. This is multiplied by.
Oh.
$1,175.
We add because this will be income to the CC. Remember that we produce the financial statements from the viewpoint of the CC, the business. So when they charge interest to Rebecca, to the CC, that will be income. Right. Then we'll have number 8. 30,000 ordinary shares in Canaan Limited purchased on 1 March 2016. They purchased them at the beginning of the year. Our year is ending 28 February 2017. That means it started on 1 March 2016. On 28 February 2017, Canaan Limited declared a dividend of 30 cents per share payable on 15 March 2017. On 28 February 2017, the fair value of shares held in Canaan Limited was determined at 20 per share. This adjustment must still be recorded. There are two things here. There's dividend income of 30 cents per share, which we are receiving. So we'll have a dividend income of 30,000 times 30 cents, which will add of 30,000 times 30 cents. What do we get?
$9,000.
9,000. We add because this is income, we'll be receiving an income. Then number 2, there is the change in the value of shares. These shares, the value of 450,000. That's the investment. But now these shares are now worth the 20 Rand each. If you say 20 Rand times 30,000, you now find out they've increased to 600,000. Right. First of all, you have to check, are these shares for trading or not? Why? If they are for trading, according to the standards, to IFRS 9, they will be recognized as income. We include it in the calculation of the profit that we're doing for the profit for the year. But if the shares are not for trading, it will go to other comprehensive income. So if shares are for trading, it's other income. And if shares are not for trading, it's other comprehensive income, which goes to market in our statement of changes in equity. Right. Now, there is no instruction in this question whether these shares were for trading or not. If you don't have an instruction, you look at the type of company. If the company is just LTD, you consider them to be for trading. If it's a public company which just says LTD, you consider the shares to be for trading. That is if there's no instruction. But if it's PTY LTD, that is a private company, then we'll consider them not to be for trading. So these ones, we consider them to be for trading. So we're going to say, because it's just, there's no PTY, fair value. But if they give you an instruction, follow the instruction. This thing of checking whether it's PTY or just LTD, you use it when there is no instruction. Fair value gain on investments. The new value, which is 30,000 times 20, minus the value that they had, the cost, which is 450,000. What do we get? I'm waiting for you guys.
It's minus negative 444,000.
444. I think
Yes.
that is a little bit wrong. It's what?
Do we take the total from 30,000
yes.
7% and we minus the 450?
Perfect.
Yes, it's minus 444,000.
I don't think it's correct. Still, that's too much.
It's 150,000.
Hello?
150,000.
I think that can be, let's see, 30 times 20, that's 600,000. Yes, that's it. I think there's a problem that you are doing on the calculator, my sister, who was giving us that figure. Right, so that was the last thing. Then we get our profit for the year. It's not our profit for the year, that's profit before tax. Right, then we'll have our income tax expense. Which is this one that we calculated here, 98,500. The one that we calculated here. Then we get our profit for the year. So that's why we left out the tax when we calculated it, because it is a requirement for a CC that you first find the profit before tax, before you subtract the tax. After finding that profit, then we subtract the tax. Then after that, we then find your other comprehensive income. Other comprehensive income will include revaluation surplus on land and buildings, and also fair value gain on investments that are for trading, that are not for trading. So if those shares were not for trading, that one, this 150 was going to come here. Or if that company was PTY, considering that we're not given instruction. Right. So we'll have our revaluation surplus on land and buildings. That's 151,000. Right, then we get our total comprehensive income. Which will be this plus this. That's our total comprehensive income. Any questions? Right. If you don't have any questions, okay, just give me a minute. Just give me, let's say 2 minutes. We'll call you after 2 minutes. Statement of changes in net investments of Jacob CC. Right. So do a statement of changes in net investments of Jacob CC. For the year ended 28 February 2017. Right, you have to identify the items of equity and the loans that we have. We have members' contributions. We have loans to members and loans from members. We have retained earnings. Then we also have the revaluation that came here. So we will have, so you create a column for the items that are there, right? Right, we have members' contributions. We have retained earnings. We have revaluation surplus. We have loans from members. We have loans to members. We have our total. Right. We will have our balances at the beginning of year. So we have balances at beginning of year. Right. Our members' contributions. Now, your members' contributions, you don't have to separate Isaac and Rebecca. You add them together. And there were no changes on the members' contributions. According to additional information, there was no way we were told that they contributed some money during the year, or maybe they withdrew some money. So we just add the two amounts together. That is 120,000 plus 95,000. What do we get?
$215,000.
That's the balance at the beginning of the year here. Right, the retained earnings were given here, 472,000. And if you can see, the balance is 1 March. So 472,000. Right, if you can check our revaluation surplus, there was nothing on the list there. So that means there was no revaluation at the beginning of the year. So that would be 0. At the beginning of the year, we mean the balance that came from last year. Loans from members. Right. Right, on the list, we are given 195,500. As long as we are not given a date like this, that means it's at the end of the year. So this 195,500 is at the end of the year. But at the moment, we are looking for the balance at the beginning of year. Then on number 5, we are told that the initial loan from Isaac was obtained on 28 February 2016. An additional amount of 100,000 was obtained from Isaac on 1 January. So that means there was an additional of 100,000, which was not there at the beginning of the year. But we want the amount that was there at the beginning of the year. So we'd say 195,500 minus the 100,000. So at this stage, we want the one that was there at the beginning of the year minus 100,000. We get 95,500. So that means before this year, the loan was 95,500. For Rebecca, it was 0. Why? because we are told that Rebecca only borrowed money on, if you can come and check here, that Rebecca only borrowed money this year on 31 December 2016. It was during the current year. Remember, our year started on 1 March 2016. So there was 0. Right. Then we'll have our total comprehensive income. I told you that on the retained earnings, we record this profit for the year, which is 247,202. Then under the revaluation surplus, we record the revaluation, which is 151,000. Then the total will go to the total column. That is the 398,202. This one will go to the total. If there was a mark to market, it was going to go under mark to market. All right, then we have other things, additional loans from members. Remember, we told that there was an additional 100,000 was obtained from Isaac on 1 January 2017. So this will be 100,000. And on that very statement, we are also told that interest must still be recorded and interest on loan is capitalized. When they say interest on loan is capitalized, you add it to the loan. So it comes in the statement of changes in equity, whereby you add it to the loan. You only add it in the statement of changes in equity if they say interest is capitalized. So you only add the interest in the statement of changes in equity if they say interest is capitalized. So we'll have interest capitalized on loans from members. Which is this one here, 8973. So we add to Isaac, it will be adding to the loan. Right, then we also have additional loans to members. Remember, we said Rebecca did not have a loan at the beginning of the year. Rebecca only borrowed funds on 31 December 2016, as we're told here. That in order to consolidate, if you check here, in order to consolidate the minor debts, Rebecca requested a loan from the close corporation. The loan was advanced to here on 31 December 2016. So which was this one here, 7,500. And loan to member, remember, we'll put it as a negative. Remember my explanation that everything else belongs to the members, but on the loans to member, they will be owing. Right. Then we also have interest capitalized on loans to members. Right. Again, you only add if they said the interest will be capitalized. And here they've said that what? The interest on this loan is capitalized. So because they said it's capitalized, we're going to add to the loan. Right. And that interest is 1175. And when we add the interest on loans, we show as a negative. Right. Then we had also, so I'm just looking out for those things that I gave you on the format. We also have interim profit distribution of 45,000. Interim profit distribution of 45,000. Interim profit distribution. Interim profit distribution you subtract from retained earnings. Right. Then there was a final profit distribution. The final profit distribution we are told that on 25 February, the members said that an amount of 60,000 must be equally distributed to them. So there's a 60,000 again. But there's a story about that. They said it was further agreed that 50% of this profit distribution will not be paid out in cash, but will remain in the close cooperation as loans from members. So 50% of that. All right. Final distribution. Converted to loan. From members. That would be 50% times 60,000, which is equal to what? 30,000. So it will be added when they convert to a loan from member, so it will be added to the loan from member. So at the end of the day, on the total, we'll only have 30,000, which is the negative 60 plus the 30. Right. Then we have your balances at end of year. So you just look out for the things that I've stated there up there. Right, our balances at end of year would be, we add up this will be our but the loans from members, you are required to show the non-current liability and the current liability. The loans from members, you're supposed to show that how much of this 234 is a non-current and how much is a current. This is to show the risk associated with the debt. We are told that 60% of all the loans from members must be repaid on 1 May 2017. 1 May 2017 is about, remember that we're in March 27, we're reporting in February 2017. It's 3 months away, which is a current liability. Remember, current liabilities are all those liabilities that are to be paid within a year, while the remaining balance is payable on 1 March 2019, which is 2 years to come, which is a non-current. So 60% is current and 40% is non-current. So can you please calculate 40% here? And then you give me my 60% here of these 234. What do you get? Hello?
%40 is 93,789.2.
And the 60.
$140,684.
So if you are told how it will be repaid, you are supposed to show how much is current and how much is non-current. But if you are not told, it's not your fault. You just leave it as it is. Any questions? So that's the statement of changes in net investments. So always remember that this one will be negative, the loans to members. Why? Because they are owing. Everything else, it means that they own it. But that part now, it means they are owing. Any other questions? Right, if we don't have any other questions, I think we can start the statement of financial position today. Is have another class at 12. So we'll continue on Tuesday. We'll do the statement of financial position of a CC. Thank you very much once again. So we'll continue next week. So as I said, so next weekend, please guys, because of the assessment, I will be forced to convert the physical class into an online again, so that we do the company. So that one will be unnecessary for those doing 1602. It will only be for those that are doing 1601. Okay, so thank you so much. God bless you richly and have a blessed weekend. And enjoy your holiday and take care.
Thank you. Bye-bye.
Bye.